Another stock that's in focus on the back of earnings is UCO Bank. And while the earnings were largely in line, stocks are reacting very positively on some of the key aspects of the management. And we're now going to be speaking to Mr. Ashwini Kumar, who's the Managing Director and Chief Executive Officer at UCO Bank. Mr. Kumar, good afternoon, and thank you so much for joining us today. I just want to start off with, the quarter four performance. It's been a very good year for you as a whole. I just wanted to start off with, the advances as well as the credit growth that's been seen. You mentioned that, there was a guidance of about 12 to 14% for this year. You've exceeded that. How are you out? What's the outlook for next year in terms of credit growth? Will RBI's liquidity measures be one of the key aspects which will help that drive as well? Anything that you can start off, at least on this, you can start us off today.
Thank you. Very good afternoon, and thanks for having me on your show. Let me share with you that this year overall performance for the full financial year has been very consistent on a quarter-on-quarter basis. If I have to compare our performance with the last year our deposit growth was 5.5%, and this year it's at 11.5%. On advances, we have crossed more than 17%. It is around 17.72%. And within the advances also, if you look at our RAM segment, retail, agri, and MSME, every segment there is a growth momentum. Agriculture we grew by 20%, MSME we grew by 18%, and in retail we grew by 35%. Within retail, if you look at my segments, the firing segments are housing loan. The major segment is housing loan, that has grown by 18%, and vehicle loan segment has grown by more than 50%. So these are the segments, and the corporate book is around 12% growth in our entire scheme of things. And advances mix, we have maintained at around 62%. Last year it was around 60%. So the CD ratio, which was 71%, now it has touched 75%, and this was our guidance of CD ratio also. So overall, if you see that the performance in various parameters like deposit growth, 8 to 10% guidance was there, we have reached 11.5. Advances 12 to 14, we have reached around 18%, and CD ratio 75, we have reached 75. So and NIM, particularly NIM, it was 2.92. Now we've clocked NIM of 3.08 on a yearly basis. So bank has been performing well on all the parameters, and our guidance for the current financial year also in the same lines. We have upped our guidance for the deposit growth from 8 to 10% to 10 to 12%, considering the liquidity in the market now, and also considering that bank has already achieved 75% of CD ratio. So there is a need for deposit growth also to fuel our credit growth. So credit growth again, we have kept a guidance of 12 to 14%, though last year we achieved more than 17%. But on a conservative basis, we have kept a guidance of 12 to 14% only. But given an opportunity in the corporate or the retail segment, we will continue to grow at a speed where we have been growing in the last year also.
Mr. Kumar, what will this credit growth depend on? Is that the RBI liquidity measures will be a boost, but what do you think, according to you, is making you so bullish on the guidance for next year in terms of credit growth specifically?
If you look at our composition of advances, that is RAM mix and corporate. So RAM mix is around 62%. And RAM is more dependent among the economy and the consumption-driven economy our India has. And we are also attracting investments from the overseas. So we feel that the demand for the housing loan and the vehicle loan will continue. Education loan, the government focus is there. Government has come out with a special scheme for the under Vidya Lakshmi. So bank is ramping up its product for the Vidya Lakshmi scheme also. In MSME also, Honorable FM had given a guidelines for bringing the cash flow based lending and totally digital. Bank has already launched this product in January itself. So, and bank has launched Project Parivartan. We are digitizing our journeys. So we expect that the same momentum in the retail segment, agri and MSME will continue, keeping in view the economic strength of the country.
Mr. Kumar, specifically, you mentioned about RAM. So retail, agri, and MSME, you're seeing some growth there. In terms of NIMs, you mentioned that for this year it's been above 3%. On a quarter-on-quarter basis, it's fallen by 17 basis points, and we might see some pressure on NIMs for all banks because the loans are getting repriced very quickly as soon as there's a change in RBI stance, and a repo rate cut. But the deposits take a little while to reflect that. Will it be safe to assume that some quarters might see some pressure on NIMs, but for the overall year, next year, FY26, you will still be above 3% on NIMs?
You are right. Because of the repo rate cut, the advances which are linked to repo rate immediate repo cut passed on to the customers, but the deposit repricing is after a lag, and we have already started seeing in the bulk deposit market there is some deceleration in the rate of interest in the deposit market currently. Again, it is again driven by the liquidity conditions, the bulk deposit conditions. So now the liquidity is surplus, deposit is available. Only one thing is there, because we are having around 23% of our SLR securities. Last 2 years we had around 26%. So we have reduced our SLR securities also. Given an opportunity in this financial year also, we will continue to work on rebalancing our securities and also to look at the refinance opportunities, so that on a quarter-on-quarter basis there can be some pressure, but on a yearly basis we will try to achieve 3% NIM as we have given a guidance.
And sir, just on cost to income, is there any scope of reduction that you're seeing essentially next year for at least this one metric? Because that will of course have a multiple effect on the profits. Any kind of outlook that you can give for cost to income?
See, if you look at our cost to income ratio, last year it was around 60%. Now we have reached around 57%. So there is already a 3% reduction. So we are working towards bringing it less the longer term at 50, but next year it should be around 55. So that is our internal target, and on that we are working on various fronts, improving our income, fee-based income and non-interest income. If you look at our fee-based income or overall non-interest income, this year also it has grown in proportion to our profits also. And if you look at our cost, we are trying to contain our operating cost. The cost which in the current financial year is slightly high because we have started spending on IT. And this year we have made a 100 crore provision this quarter, 100 crores provision towards the IT expenditure for which the projects which we have already initiated. So next year also some IT related expenditure will be there. Overall, we have kept a budget of around 1,000 plus crore, which 60% is capex related budget and around 40% is revenue budget. So, but our endeavor is to bring it down to 55% in the next year.
Final question, Mr. Kumar. You also announced a raise of about 2,700 crores via equity. Any kind of conversation that have already happened in that aspect, and I just wanted to understand from you as well. What are your expectations essentially on ROA going forward post this equity raise?
See, if you look at our ROA, we have gone for QIP in March itself, and on expanded base, our ROA has improved from 0.59 in financial year 24 to 0.76. It is already improved, and our earning per share has also reached rupees 2 now. So we are working towards reaching 1% ROA, but we'll continue to improve our ROA on a quarter-on-quarter basis. I believe that next year, not this year, next year we should be touching 1% ROA. So far as the capital raising, board has approved and recommended, and now we will be taking up the agenda in the AGM for approval, and then we will be reaching out to the government for their approval to raise equity to dilute the government holding in this financial year.
Mr. Kumar, we'll leave it at that. Thanks so much for joining in, giving us a lot more insights on UCO Banks this quarter as well as FY26. We wish you the best.